Good afternoon and welcome to SRT Live. I am your host, Sean Richard with the Sean Richard Mortgage Team. Thanks so much for joining me today. Oh my goodness, is it finally peak inflation? Have we seen peak inflation? That is a big part of our topics today. We've got a lot to cover. We've got a lot of information from last week pertaining to the housing industry. We've got a lot of information coming up this week. It is a jam-packed episode, and we're going to dive in right now. Let's get into last week's numbers. All right. So last week, we got a slew of information, starting with the NAHB Housing Index. This is the National Association of Home Builders Housing Index. This measures home builder confidence and outlook going forward. As expected, this declined. We are seemingly heading into recession. Home builders starting to brace for the market ahead of us. And so that home builder confidence dropped from 46 down to 38. And so that's projecting shrinkage in the industry, in the home building industry. You can start to see home builders slow on their pace. We're going to talk about housing starts and permits as well, and home builders not super optimistic going forward. Now, we're going to talk about inventory and how that all plays into our industry, but know that right now home builders are losing confidence a little bit. We also got housing starts last week. Housing starts actually down from 1.566 million annualized pace down to 1.439 annualized pace. So a pretty significant drop, down 8.2% in housing starts. So we're seeing those numbers come down. The speed, the pace of that construction is slowing down. And that's going to spell less inventory. So for those of you out there that are listening to the media talking about the sky is falling, housing crash, just know that the housing crash can't happen if we have low supply and moderate demand. You know, housing crashes happen when we have extremely surplus supply and little demand. Demand has been shrinking. Supply is also going to be shrinking as we head forward. So keep that in mind as you're listening to news media, as if you're a real estate agent, if you're having conversations with clients, if you happen to be a buyer or a homeowner looking at this and saying, what should I do? Know that we are still going to continue to see a relatively strong housing market, and I'll go into more detail here in a minute. All right, so that was housing starts. We also got building permits. Now, building permits up just a tad, up 1.4% from a 1.542 million annualized pace up to 1.564. And building permits is for construction projects kind of as a whole. So it gives us a general idea of how construction is going, because in general, as construction goes, so does building, new builds, and housing inventory does pick up there as well. We also got our normal jobless claims last Thursday. This measures two things: initial claims, individuals filing for unemployment for the first time, and continuing claims, individuals renewing their unemployment benefits. So initial claims actually fell from 230,000 week over week to 214,000. Market analysts were expecting 226,000. So we came in below that estimate. And this is an interesting report because we've seen the unemployment filings stay relatively low over the past several weeks. But we keep hearing reports of companies laying off individuals. So what this likely means is we're seeing some companies that are hanging on to employees longer, and we're seeing other companies lay off people, but we're also likely seeing job openings decline. And we're going to have to take a look at the next JOLTS report, which is the job openings report, to see if that actually is coming to fruition. So that was the initial claims month over month. Year over year, continuing claims, we got month over month, 1.385 million. This was up just a hair from last month, 1.364 million. So continuing claims are staying relatively flat as we see initial claims come down a little bit. We also got existing home sales. Now, this is the pinnacle of housing data every month. Existing home sales makes up about 90% of our real estate market. So it was existing home sales came in at a 4.71 million annualized sales pace. Now, this is made up of single family, condos, and co-ops. Ultimately, that's down 1.5% month over month. And as you might expect, existing home sales down significantly year over year, down 23.8% year over year. And that is a direct result of not only just rising prices, because that have been happening over the last couple of years, but of course, rising interest rates, as well as relatively low inventory. Although inventory has picked up in the past several months, we have seen inventory overall shrink and stay relatively low. So low inventory, higher prices, higher interest rates, slowing down existing home sales. You can't sell what's not on the market. All right. That was last week. Tons of information. Looking at today, we got some great housing appreciation data from FHFA and from Case Schiller. Case Schiller came in at a month over month negative 1.1%. And so I know what you're saying. Well, see, Sean, home prices are coming down. And I would agree with you on a national level. However, if we look at the Case Schiller report and we remove 5 key markets, Seattle, San Francisco, San Diego, LA, and Denver, not Dallas-Fort Worth, not Austin, not Houston. If we remove those 5, Seattle, San Francisco, San Diego, LA, and Denver, the remaining markets across the entire country came in about flat. So there definitely are some markets that have seen exceptional price acceleration over the past 2, 3, 4, 5 years. And some of those markets are cooling at a rapid pace. Right now, for all other markets, we're seeing price stability as a general rule. Now, there may be the case by case, but ultimately, we're seeing pretty solid price stability. Typically, during a recession, or I should say, every recession that we've been in as a country since 1960, with the exception of 2008, which was a crash, and a brief blip at the 99-2000 rollover, every other recession, we've seen home prices do one of two things. We've either seen them continue to rise or we've seen them plateau, only to continue to rise after the recession's over. So keep an eye on that. We may see some short-term plateauing or declines, but I think in the grand scheme of things, we're going to continue to see home prices rise due to the low supply that we have, among other factors. All right. That was the Case Schiller. Now, FHFA, which measures single-family homes with a conforming loan amount. So conforming loan amount meaning less than jumbo. So homes with no mortgage. This doesn't take into consideration those. Any homes that have a jumbo loan amount, which currently is anything over the amount of $647,200, does not take those into consideration. So FHFA month over month was down 0.7%, and then year over year was up 13%. So we're still seeing some solid appreciation in general. We're obviously cooling from the critically high levels that we've been at over the past couple of years, which was 100% to be expected. We couldn't maintain those levels for long periods of time. All right, we also got consumer confidence. Now, consumer confidence measures consumers' optimism about the forecasted economy, where we're heading. And the index result is compared to the baseline that was set in 1985. The baseline is 100. So above 100, consumers are more optimistic than they were in 1985, and below 100, consumers are less optimistic than they were in 1985. So where do we land? We came in at 102.5. Now, this is down a healthy amount from last month's reading, and we are getting a little bit closer to less optimistic. Now, If we roll into a recession and conditions worsen, we're probably going to see that dip a little bit further. If we start to come out of the economic turmoil that we're in right now, we should start to see this start to rise. So we want to keep an eye on this on a monthly basis as well. We also got the Richmond Fed Manufacturing Survey Index, and that's a mouthful, right? So this gives us a really good key in on the health of the economy, because ultimately most everything starts with manufacturing. So there are different manufacturing surveys that come out from different regions of the country. This was the Richmond Fed Manufacturing Survey Index, and this came in at a -10 on the index scale. So what does that mean? Well, that means that the manufacturing companies that were surveyed are showing shipments and new orders have fell. So we're seeing that come down. We're decelerating there. However, there was a note in the index report that showed that prices, input prices for manufacturing, are still increasing, and so that's very much inflationary. And the reason that's so important is because you've heard me say it: inflation is the enemy of interest rates. Inflation pushes the price of mortgage-backed securities up, which has an adverse effect on mortgage rates. So inflation goes up, interest rates on mortgages go up as well. Okay, so looking ahead to this week, we've got new home sales tomorrow. Get a pulse on what's going on in the new build community. We're also going to get the European Central Bank (ECB) rate decision on Thursday. So the ECB is essentially the equivalent of our Fed. So we're going to get their rate decision on Thursday. As always, we're going to get jobless claims on Thursday, and then we're going to get the first reading of Q3 GDP. And this is important because the old school definition of a recession is 2 consecutive quarters of negative GDP. Well, Q1, we had a negative reading. Q2, we had a negative reading. So by that definition, we are in a recession. If we get a Q3 negative GDP, then that is an extremely strong indicator that we either are already in a recession or we will be heading into one. And that is also important because we want to recession proof ourselves. We want to put habits and actions in place to help you get through out to the other side of the economic downturn. If you're a real estate agent, that means we want to help you thrive and put things into place to continue to help clients into homes where it makes sense. If you're a homeowner or a home buyer, we want to make sure that we set you up for success as well. So we have, in our history of our country, we have not had 2 consecutive quarters of negative GDP without a recession. So to say that it's a strong indicator would be a bit of an understatement. All right, so we get first reading of Q3 GDP on Thursday, and then drum roll, on Friday we get PCE. This is personal consumption expenditure. This is the Fed's favorite measure of inflation. The core PCE, which strips out food and energy, that is what the Fed has a target of 2% on. So this is going to be a very, very important inflation report. This is the last inflation report that we're going to get before the Fed meets in November. And I may have to double check that. We might get consumer price index. So this is going to be an important report, but we are expecting inflation to show elevated on this report since it's for the previous month. My anticipation is we're not going to see inflation start to come down until we see November's inflation reports for the month of October. Right now, this is the final inflation report in October for the month of September. So we're going to look for that on Friday as well. And then lastly, also on Friday, we get pending home sales. So another big housing report. We're going to watch that closely, see where homes, signed contracts on existing homes is what that measures. And so that's going to be an important gauge of existing home sales for the following month. All right. So, what are we focused on? What are we watching going forward to understand our industry, to stay in tune with what's going on in the economy, to help us navigate it better? And the first and foremost answer is inflation. You heard me talk about personal consumption expenditure on Friday. We've got a couple of reports in November that we're going to be very interested in seeing to see if we have, in fact, hit peak inflation. We get the Fed meeting in November as well, where they're expected to increase the Fed funds rate by another 75 basis points or 0.75%. So we want to watch that as well. And then we've got midterm elections, November 8th. We've got Congress and the House, midterm elections coming up. And this is going to be a market mover for sure. Right now, we've seen so much volatility in the economy and in the markets leading up to this point. Normally, prior to elections, there's a calm before the storm. And so we haven't seen that calm. So the question is, are we going to get calm after the elections, or are we going to see further volatility based on based on the controlling party going forward? Now, I'm not going to get political on you, but it is going to have an impact on not only the economy but our housing market as well. So we're obviously going to be watching that going forward. All right. Well, if that wasn't enough for you, I will be back next Tuesday with another market update, keeping you in tune with what's going on in our economy and in the real estate market. If you have questions, I want you to reach out to me at the number listed below. Always welcome to comment down below as well. If you're watching in the Powerhouse Facebook group, thank you so much for being an incredible part of our community. And if you're checking us out on our YouTube channel, make sure that you smash that subscribe button so that way you can have up to the moment information in the palm of your hand. All right. Well, I am Sean with the Sean Richard Mortgage Team. Thank you so much for tuning in for this episode of SRT Live. Have an incredible rest of your week.